Okay, guys. 10:05. I like to get started right after 5 minutes after the hour. This will be very interactive today. Anytime you guys got questions, just raise your hand. We'll stop, answer questions. Because if you're thinking of a question, other people probably have it too, or they just haven't thought of it yet. But they will have it later. So feel free to interrupt me. So this is about OwnaFleet. This is a platform that I put together for a problem that I experienced in my life. I originally was a dentist, worked for a couple other guys for a couple of years, decided to start my own shop from scratch. It was the hardest thing I ever did. I mean, learning a business on the fly, leadership skills, all those things. Made no money my first year, wanted to quit. Nobody would bail me out of my practice, though, so it forced me to double down. Pushed through all the pain. Within 3 years, we were the largest practice in the region, about 500,000 people here. So about, 175 dental practices. We were the largest after 3 years, just doing the good habits. That was a great experience. And, wasn't paying much taxes when I started. Wasn't making a lot of money, and then had the depreciation from the practice the first year. But after that, all of a sudden the taxes hit me, like a brick in the forehead, and I didn't like it. And not to get into politics, but I just didn't like how I saw the state and federal government investing my tax dollars either. I didn't feel like it was very efficient. And so I decided to change my tax returns, change my tax facts. So I did deep dives into the tax code, talked to everybody I knew for years. Tax attorneys, accountants, attended webinars, everything. And when I was a full-time dentist, this was the best solution I found to recharacterizing my income and utilizing depreciation to with like a tangible synergistic business to my dental business. Dentistry, once you get going, can create really good cash flow, but its tax treatment is terrible. So I was looking for a business that I could pair with it and really bring down my tax bill. So we'll go into that more today, but the big thing here is if you have a big tax bill, especially ordinary income tax, like what can I do? And so here's the solution we built out. It's the most simplified, it's the most elegant, it's the most time efficient, it's the most tax efficient solution I've found in the 8 years that I've done deep due diligence. So, okay, so you own the equipment. This is your equipment. You run the business. Part of my platform is a major publicly traded U.S. rental operator. One of the biggest issues I found when I did this my first couple of years is I would work with local operators or other operators in the other parts of the country who would rent the equipment from me, and it was just a lot of work. Just more work than I wanted to put in, more risk than I wanted. And so now that once I found the publicly traded partner, right, all financials are audited, right? It's great there. Financially, you know exactly I know where they're at, and they're doing great. And so it's very synergistic. For them, it helps them keep equipment off their balance sheet, which is super important. And for us, you have this partner in your equipment business that reduces risk and reduces time for you. So the same dollars buy something. So it's, tax year. I don't know what your guys' taxes are, or if you're doing this for clients. A lot of folks I work with are CPAs, financial planners. And, a client is having a big windfall, 20, 30, $40 million. How do we recharacterize one's assets to minimize the tax treatment? How do we, I'm making $1 million, $2 million, $3 million a year, usually minimum 500K. I'm paying 300,000, 600, 800,000 in taxes. What can I do about that, today? So instead of sending that check to the IRS, now I'm retaining those funds. Now those funds are still mine because I'm doing what the IRS has shown us in the tax code, has shown us with the big, beautiful bill with bonus depreciation. You know, the federal government wants us reinvesting in the country, wants us growing businesses. And so it's like, how can I do that and benefit in the short term on with my taxes as well? So yeah, it's your business and it's got real scale. You can scale it up as much as you want. We buy 400 to 600 million in equipment. So unless you're planning on buying more than that, you know, you've got scale. And the exit's defined up front. So our typical model is a 6-year horizon on this. So you have that in place. Two things to work out with your accountant is like whether the equipment, I mean, typically it qualifies for 100% bonus depreciation, but work with your accountant. Disclaimer, I am not a CPA. I am not a financial planner. I am not a tax attorney. So this is for educational purposes and my personal experiences, you know, vet with your professionals. And then using these deductions, you know, because you're on the debt at risk basis and you have material participation. From my understanding, that's 100 hours a year and more than anyone else. And so for me personally, that's way easier to hit than like material participation in real estate. When I was a full-time dentist, you know, when you have to be 750 hours and more than anything else I did, which is very hard when I was an active dentist. So my understanding of the tax rules and our clients who've done this is it's much more accessible. Yeah. So now then I'm no longer running the dental group as of 2.5 years ago. You know, I do real estate development. I'm a contractor. I'm an excavator. I have about 200 million worth of development locally in Spokane. 3 projects under construction. I start a new project about every 4 to 6 months. So have about 4 projects queued to start over the next 9 months. So for me personally, as a real estate professional, I get very good depreciation tax treatment, but it doesn't always delete all of my income each year. So I have all my real estate depreciation, and then anything else I need, I find it very beneficial to add equipment to my equipment business, get my taxable income to around 0. And that's how I've been leveraging it, and it's been very effective for me. Yeah. So as we talked about, instead of sending the money to the IRS, you're keeping it. Typically, folks use first year bonus depreciation. Before bonus depreciation came back at 100%, there was another piece of the code called Section 179. But once bonus depreciation 100% came back, that's what I see most people using now. So the hardest part, though, is none of us have the time and expertise, even if they're sharp, to start our own separate business. It's way too much. It affects family life. It affects mental health, physical health. So it's how do I create a synergistic side business here that's successful, but I'm leveraging someone else's platform. So that's what we're focused on today. Any questions so far? We're going to continue to dive in, but if someone's got a burning question that popped up for them, I don't want to. I want to answer those as we go. So, anything yet?
Yeah. So there was there's a requirement to put in 100 active hours into the management of this fleet, kind of like the equipment version of the reps minimum involvement. Yep. Is that right?
There's multiple tests, and there's multiple tests, and that's the. And I'm going to preface this, Steve, before we dive into that. I was going to preface, not
like I've seen you in like a tractor with a hard hat on, and I was wondering, were you just getting your 100 hours in each time you like open a new commercial?
Yep. So, yes, what does that look like? So, not an accountant, just my personal experience. talk to your tax professional, is when you go through the requirements for material participation for this, there's a few different options. One of them is 100 hours and more than anyone else. And so for me personally, we have, like I said, 400 to 600 million worth of new equipment in the platform. So there's not going to be anyone and thousands of employees in the platform. There's not anyone who's going to be working on the equipment more than yourself. So that part's taken care of. And then the second part is 100 hours. So yeah, what does that look like? I go into that more, but it's really management of your equipment. So you go through, what I do is I like to track it in an Excel file, right? In case there was ever an audit. First of all, I put it in a partnership because partnerships get audited way less than single member LLCs. Even if someone gets audited, the deep dive during that audit typically does not go into deep dive of partnerships. It could, but it typically dives into single member LLC. So I just kind of structure things where I'm like, least risky, right? And then two, I just track my hours. So any kind of like repair, opting into the leasing, I have a whole list that might be in this presentation, but there's like a whole list of activities, let's say like 10 of them, Steve. And it's like, okay, here's my list of like material participation activities. Here's my list of non-material participation activities, just log hours, right? And have that in a spreadsheet if one ever gets audited.
Okay. Yeah. Thanks.
Good. Okay. It's very similar to the real estate. So, and I can't technically give advice on this stuff, right? As not being an accountant, but I can tell you what I do, and I can, offer that. So,
great.
The two big people, like I said, are windfall pieces. So some people want to. So with the windfall piece, it's usually not the whole piece. Like we use Opportunity Zone a lot for capital gains. That's a fantastic program for capital gains. But we do have a ton of family offices, big folks writing big checks. SpaceX, those types of folks, 10, 15, 20 million bucks. Let's recharacterize some of this income. We see that a ton. And then the high income individuals each year. And once people do it the first year, unless their other tax facts have changed, we have a very high rebuy rate. People just kind of doing this every year, continuing to grow their equipment business, here's their cash generating business, here's their equipment business, very synergistic, using those two together. Okay, before I dive into the numbers, anybody have situations that they want to mention to me so I can kind of cover as we go through the numbers? Like what kind of year is this? Is anyone having a business sale? Passive K1s, active K1s, W-2 income? Like what problems are we kind of trying to solve in here? Anyone want to mention it so I can make sure to address it?
Just income for me.
Income, okay.
Here, yeah.
Is that W-2 or in W-2 and business mix? Steve, buddy, is it just W-2 income, or do you also have like distributions from your business?
Oh, sorry. Essentially pure distributions, but the clients, the high income clients I work with, probably one's a W-2 and then others are W-2/distribution.
Okay, both. Thanks, bud.
And Josh, if you could touch on just 1099 as well. I don't know if it's like the same as W-2, but I'd like to hear about 1099 from my end.
Yeah. I'll touch on 1099 as well. Okay. And anything else?
I mean, for us, it's we've got K1s from some partnerships that we have on multifamily, and just basically being able to, we're not 100% owner on those, so we're not able to max depreciate, so if we only 20% or 30% on that particular property, and that year's depreciation is like 250,000, I'm only able to max what percentage of ownership I have. So basically, just looking for different avenues to um, lower our tax burden. We do own, dental business as well, and expanding the dental business to multi-unit as well. So just other lines of income coming in, and just trying to lower our tax burden in general.
Mick, is that real estate passive or active? Do you know on the
Which one?
We have both.
both? Okay, both passive and active. Okay, great. Okay, anybody else have a different situation between that they want to share that so I can make sure to touch on for you?
Mine's just distributions from work combined with W-2. So just around a lowly million.
Okay. Chance, you're doing great. Okay, anybody else? Peck, Ray, or Carolyn? Matt, Hardivan, Michael? Okay. Anybody else done anything like this before that I can touch on? Doesn't have to be exactly the same, but just maybe you were solving the same problem with another solution and you'd like me to touch on that today.
Hey, Josh, sorry, can you hear me okay? This is Matt.
Yeah.
So my situation is we're working with the US family office that's looking at this. And I think everything's been very clear. I don't really have any questions on what you've discussed so far. The only thing that they had asked us to check was, is the end counterparty, whether that's equipment share or an entity in between, is there any like guarantee of repurchase price, or if the residual value at the end of 6 years is below, I don't know, X%, that they share some of that loss? So basically any downside protection on the residual value was a key question for them. Other than that, everything seems really attractive.
Okay. I'll go over that. Anybody else? Anybody done like oil and gas or tax loss harvesting or any other type of similar solar? If anybody is or has, I can always kind of go on a direct comparison so you can quickly see kind of the differences and make educated decisions about what's best for you. Okay. Yeah, so I'll touch on these as we get into this, probably in like 2 or 3 slides. So 3 primary returns. So you've got your monthly rental income coming in. Typically, depending on interest rates, which is personal to each person, we give you once we kind of figure out your lending with you, we help on that a lot as much as we can and do most of it. Your cash on cash return is typically going to be 6 to 8% a year, depending on interest rates. Then, as I mentioned, the big benefit there is just the, $1 million you're going to send to the IRS. Now you're keeping a large chunk of that and you're reinvesting it how you'd like. I was honors finance in undergrad, so like time value of money. That's a big benefit here. And then this is like real mobile collateral. You'll have all the serial numbers. You'll have access to exactly where your equipment is. Anytime you want to look it up, you just log into the software. You can see exactly where your equipment is. The maintenance, the next there's like 50 different pages in there. And then it's mobile collateral. So you're not succumbing to like regional risk. Like if like a city, all of a sudden the big employer shuts down or something, we could just move the assets to another location. So that's another nice piece. Yeah, let's talk about $1 million and run through the numbers. And I think this will be the best time to talk about the different income sources. So, so on a typical deal here, I just use $1 million worth of equipment purchase. I think the smallest we usually do is 500K worth of equipment. If somebody starts early enough and it's not like Q4 where things get really busy, and we have a good relationship, we could possibly go down to 250K if all the lending stuff works out. So we're into long-term relationships. So we're always trying to serve people at Cochran Capital. So, yeah, Cochran Capital is like I run a few funds. I do this. OwnaFleet is under Cochran Capital, if you hear me use that term. So, yeah, typically for $1 million, you're putting in $130,000 initial cash outlay. 10% is that like down payment on the loan. 3% is like a one-time fee for all the work we do, all the work our other platform partners do. Annual cash flow, like I said, just depends on your interest rate. The last year you get your 10% down back is how the model's set up. So here's kind of the economics. On $1 million, this is potentially $400,000 saved. They use a 40% combined marginal rate here in this example, 37% for top federal rate, and then 3% for state. And we're just using 3% as an estimate because every state's different. So when you run the math here, I do have some other slides I could show on that. I don't think I put in this presentation, but if you're making sound, strong investments, you're not like blowing the money on cars. If you run the math over those 6 years, it's very favorable to take this money and invest it, and your returns create a lot of wealth potentially for you. So it's a good program. Here's a breakdown of that example, like year by year. So if you're going to do $1 million, or you're going to be 130,000, if you're going to do 500,000 with equipment, it's typically around 65,000. So about half. Here's the revenue share for your equipment every year. Here's your operating expenses. If any of you have run other businesses, this is a very low operating expense, especially for equipment. So this covers like all the maintenance. If there's an equipment repair that's needed, this covers insurance. This covers the technology fee for the technology that's on your equipment, so you're seeing it. I have an excavation company. We have a lot of heavy machinery equipment. As Steve mentioned, sometimes I hop in. I'm not very good at it, but sometimes I do. And so, yeah, this is a very lean and mean, efficient cost there. This is your net operating cash flow, and then you're going to retain debt service. So this would be like an estimated cash flow at the end of the year. Yeah, so this is the revenue share that we have with the program. We get most of the money up front till you guys are covered, and then after that is our platform partner, our publicly traded platform partner gets a majority after that. And then these are just the fees, like I said, which is maintenance, repairs, insurance. This is not a profit center for us. This is just like, let's create a CapEx account, so it's covering everything. So you're not paying out of pocket for that. Yeah, let's answer this question here. So Matt, was that you that was talking about the residual value?
Yep.
Yeah. Okay. So I'm a big due diligence guy, being a finance guy. So that was the big question I had as well. So this is how I look at it. I go back to like the worst recession in like recent times, which is like 2008, 2009. 6-year-old equipment at that time, when we pull the data, was selling for 40% of purchase price. Okay. The buyer of this equipment to start buys $1.6 billion probably ballpark this year of equipment. So it could be the largest purchaser in the country. So they get very good pricing. Okay? They resell it to us to get it off balance sheet. When they resell it to us, they make a little bit of money on that, but we're still typically coming in at this equipment much cheaper than we could buy retail. So like the day you walk in, just like with real estate, when I try to walk in and I purchase it for less than the appraisal, like same here. So we're buying into a cushion there. At year 6, the target with the program, and everyone wants to make this simple for everybody. Nobody's trying to complexify or create extra risk for folks. So it's the 54% of original value. Okay, that's what the model's built off of. In that downturn, 2008, 2009, prices were at 40%. Okay, so on that million after 6 years, 400,000. In our model, after 6 years, that million's at 540,000. So there is a limited loss guarantee as part of the program offered by our publicly traded partner at 9.99%. So out of that drop from 540,000 down to 400,000, the way the platform is set up is, 99,999. It's called 100,000 of that drop is covered. So if we're going from 540, let's say 6 years from now, the worst recession happens in 30 years. And your equipment at that time is worth 400,000. You're not forced to do anything. I mean, you have options. It's your equipment. But if you were just like, I just want to sell it at today's prices, then if we use those numbers, that's 400,000. But the limited loss covers about 100,000 of that drop from 540 to 400. So based off of the last session, when I run the numbers, net risk to me would be about 40,000 in value that would be coming out of my pocket on that million. The other thing you got to remember is these large equipment rental companies, when they're renting out a piece of equipment, whether you rent new or used, they charge the same rental rate. Some of them. These rental companies love used equipment because they have better returns on the renting of that equipment. And, they've been doing the maintenance for 6 years, right? So this isn't like foreign equipment they're buying off an auction. They know this equipment. They know the maintenance records. They're fully aware of this equipment and how it's been taken care of, right? Because they're the ones been doing it. So they want to buy this back. So, Matt, what follow-up questions do you got to that? That's a great question that I think everybody needs to know the answer to. So thank you for asking.
No, that's it. That was really helpful. Thank you, Josh.
Yep. And I rent a lot from this company too. We rent a lot of equipment, stuff that we use, all day, every day. That equipment we purchase, but all the stuff that we need this for 3 weeks. Oh, we need this for a month on a project. We rent all that. It doesn't make sense to own. So we rent from this company. We really like them. Out of all the local rental companies for construction, they're our favorite. We have good relationships with the local manager. They hire a lot of ex-military. That's been kind of their best management group. It's been good. So publicly traded, national rental network, telemetrics. So yeah. So one of the things I hated with equipment stuff that I'd seen in the past is there wasn't transparency, right? Like a lot of us have heard about this ATM thing that went down where like they had X amount of ATM equipment, but they just kept like using the same serial numbers, right? And it wasn't real, right? So like a publicly traded company, like they're audited up the wazoo, and you've got the telematics. So this is completely different class level of security, and that's what gave me comfort to launch this platform. Lots of participants, lots of money through. Independent, limited loss. These are the main types of equipment we see, and it's really based off demand. We don't get to pick our equipment. It's whatever the demand is, but aerial lifts are probably the most popular. Scissor lifts, telescopic booms, articulating. These are the most popular. Then there's material handling stuff, forklifts, telehandlers, and then a lot of the stuff we use, dozers, excavators, skid steers, those types of things. I think last batch of equipment I got, maybe average price of equipment was maybe 100 grand, 130 grand. So it's not like you're going to own one piece of equipment if you're buying $1 million. It's usually multiple pieces of equipment. And when you like sign on the dotted line, right? Okay, I'm going to commit to this loan and I'm committing to this equipment. You have both of those in front of you, so you know exactly what you're buying at the time you're buying. You know your projected numbers, like everything. Yeah. So this is your business. Like you set the floor price. Like we're designing it to make this easier for you, to simplify it, make it more predictable for you, because it can be chaotic to try to run another business, very chaotic. But at the end of the day, this is yours. And so it's your business. You make the calls. Let's talk about income. So again, not a tax accountant, but my understanding of the tax code is there's something called earned business loss. If you are a W-2 employee and you're married, the max depreciation you can take per year through this program, to my understanding, is $512,000. So talk to your tax professional, but just on W-2 income. Yes. For business income, like profits distributions, my understanding is it's unlimited with bonus depreciation. So if you're a business owner, like you can continue to take more there.
And you can can you carry that forward too?
Yeah.
Like you can. Okay.
Yeah, it's a great question, Leland. I think one of the biggest things when people are like, okay, I'm ready to go, how much? Let me cover that. So I typically, my stuff is very complex, like all my income sources. So it's very hard to predict. How I look at it is when I go through the application each year, I pick the most that I could possibly need, because lenders, you can always peel it back some, but if you try to ask more from lenders after they've already kind of gone through their lending committees or whatever, then it just takes more time, takes more work. They have to re-underwrite. So I kind of pick like the higher number to start with and get through the lending applications, the interactions with the bank or credit union, the lender, and like I'm approved for like X amount, and then maybe that took 6 weeks. Okay, now I maybe have some more information from my accountant. As Leland mentioned, like what happens if I guess too high in the equipment, whether there's like a net carry forward losses, right? It's like a piggy bank of depreciation that you can carry forward to the next year. And then you can use like 80% of that piggy bank each year. So whatever your piggy bank is, you can apply like 80% from that piggy bank, is my understanding. Talk to your accountant. So there's not like a negative to buying too much. And then on the flip side, if you underguess it, well, the depreciation affects like your highest, your income at the top, which reduces your tax percentage, right? Down from 37% to like the lower number, right? And so if you don't get quite enough, okay, now you're paying taxes at 15%, right? Instead of 37. So it's like, it's still super beneficial, even if you don't pick enough. Leland, did I cover that fully?
Yes.
Okay. And then for Mick, with like passive and active, just make sure you match, those income sources, right? So if you're doing the material participation piece and you're using this as an active, just know that that's going to count against your active typically, right? And then if you're doing this as a passive thing where you're more like delegating it out, that this depreciation would match with your passive income. Yeah, but like K1 stuff, talk to your accountant, but typically that would be unlimited, to my understanding. Mick, did I answer all that, or?
No, you did.
I did. Okay.
Question on I guess from a market saturation point on rental equipment, where's this equipment basing? Is it based out of like Spokane, the majority of it, and then y'all have I guess where's it housed, where's it stored, and how is that market determined where it sits based upon growth of those cities and states?
Yeah, so I like to pick winners. So the market in general of equipment rentals continues to grow. Part of that is we're just continuing to grow as a country. Construction continues to happen. Also, like risk. If I'm like running a business and interest rates are this high, it doesn't make sense for me to have all this equipment on my balance sheet, right? Just paying for that every month, whether I use it or not. So you see like this very reliable rental equipment, just high utilization of it. The business as a whole is going very well. And then within that business, you know, there are multiple large players to the country, and our player has been the fastest growing. They're doing well, they're growing, and a lot of that is from their leveraging of their technology and a few of the other strategies they've implemented for their growth. And so, yeah, so I like to attach myself to somebody who's gaining market share, right? Who's doing well, publicly traded, but growing, doing well. And then diversification, they're all over the country. So, like I said, if I think there's over 400 locations now. So if, you know, a certain market all of a sudden slows down, they just send more equipment to another market. I mean, when I meet with the Spokane manager, he's like, oh yeah, like sending equipment over here, like, you know, 3 hours away for this project, or this site needs this. And so the equipment's constantly getting shifted. Another thing that's done is like, let's say there's a big project like a data center or just something bigger. What they'll actually do is take a piece of dirt, lay down a bunch of equipment for that project, and then whenever the construction companies need that equipment, they go over to just punch in the code, grab the equipment from the dirt yard right there, and just start utilizing it. So it's very much like technology driven, nationwide, demand driven, flexible. Yeah, did that answer that, Nick?
Gotcha. I didn't do enough due diligence when I jumped on the call, so I was trying to figure it out because personally, I would like to own some equipment to be utilizing here locally for myself. So I was like kind of taken back on how the fleet aspect of it was. So no worries. And then actually, because I mean, active participation is something that I'm definitely involved with and have, you know, met and exceeded the 750 hours for rep status. So I guess the active side of this is just looking at the app and saying, and then doing what, I guess. Because I mean, if it's not on ground, not locally touching the piece, so how do you manage that actively?
Yeah, so there's about 8 to 10 main items I use, and I have a list. I'm sorry, I just have like 30 pages in this thing, and I mean, you've got your floor price. Here's one of the lists. You got your floor price, you've got your opt-in to the program, right? You can opt out of the program, so you're making like opt-in decisions. We've got, you know, insurance, you've got repairs, you've got maintenance, you've got financing and personal guarantees, amendments, disputes, billing. But there's more of a list. But yeah, you and your accountant kind of sit down and, you know, I recommend documenting non-material participation hours too. I can't recommend. I personally like to document non-material participation hours as well. Like, okay, here are all the hours I'm putting in, and here are the material participation ones, and here's the ones that are not.
Right.
So.
Okay.
Hey Josh, one question that we got here from Jitesh. Are there any implications for risk for any individual that's on an H-1B work visa?
You know, I haven't dove into that one yet. Jitesh, let's make sure, Jeff, you post your email, and then Claudio will follow up with an answer to your question. I'll throw it through my model and get you those answers. And then Leland, for the 1099, I literally looked this up last week and I'm blanking. I want to say there wasn't a threshold, But if there was a threshold, it would probably be the 512 again, but I want to say there wasn't one, but I need to follow up with you as well, Leland, and make sure. Would you also put your email so I can give you what
Sure.
I'm seeing?
And are the requirements the same as the W-2 for like material participation, like to classify this as I guess active. Yeah.
Yeah. Yeah. My understanding is those are yep. My understanding is the same rules, but again, talk to your accountants. So, yep.
Well, do you like work off any sort of, I think you'd mentioned that you have like a checklist or something. I mean, even if it's not fully accountant approved, how do you like, first off, like, do you have a list or like a starting point to like do that? Because I mean, that's pretty
helpful.
That's a pretty big thing to cross off, of course.
Yep. Huge. 100%. I do. The hard part is like when you're not an accountant, right, or a financial planner, like those types of things, you can't say like, here's this. But I could email you kind of what I do.
That'd be great.
That would be good.
Like a starting point to see like if it's doable for me and like the documentation. I mean, I feel like that's pretty big just to be comfortable with it, and I can kind of take it to my accountant and see what he says.
I'm all about service, Leland, and making things easy for folks. This is purely just like the federal rules, right? That make it hard for me to do that, but I will, do exactly what I can to make it easier for you. Yep.
Okay. My chat's disabled, but I don't know. I'll get with you after or something.
Yeah, no, we want to handle that. Andrea, can you work on allowing Leland
I just allowed everyone to type into the
into
chat.
Tesh? Yeah.
There we go. Let me know if that worked.
All right, here's some other questions. Any other questions off the top of your guys' head?
Yeah, Josh, are we carrying insurance on the equipment, or is that part of the 2.94 or whatever percentage it was?
2.94 is covering, but also like there's two other insurances too already there through the publicly traded company. So like typically the renters have their own insurance. The publicly traded company has their own insurance. So the insurance we carry is like more of like an umbrella type insurance. So it's not like your insurance is on the front. So yeah, and then that 2.94 does cover that. So that is the idea.
Thanks.
Yep. Yeah, that was one of my first questions. When I started working with it, I was like, I don't want to be liable for this stuff. Like, yeah. Okay, so actually owns the equipment. It's you. You have to. My understanding is the tax code is you have to be if you want to active, you have to be at risk. So you have to be on the LLC. Yes, there's built-in equity from day one. Like I said, because they buy the equipment for like 60 to 80% of what I could buy it for. So yeah, they really get good deals to that $1.6 billion volume. Personal guarantee, got to be at risk, at least for the active side. The biggest risk, I mean, there's a ton of risks in anything we ever do, but the biggest one for me is the industry side, like a big depression. I already like measured that risk for you. I like construction because it's one of the first industries to come back post-recession, because that's how we typically stimulate the economy, like new private construction, like new businesses, new manufacturing, but also new civil, right? New roads, those types of things. So I really like that one. What if my equipment doesn't get rented enough? So one of the things we've done with the platform is we pool equipment. So like, let's say this 50 million of equipment gets pulled together. That way, if your equipment falls off the truck or something, it's in repairs for 2 months. Like it's not affecting like your specific cash flow, right? You're not all of a sudden going negative and like, oh no. So, so we do that. Can I actually use the depreciation, like, between you and your CPA, obviously, but that is probably one of the most attractive things about this program for most folks. Rebuy rates, we about 93, 94% rebuy rates. So people, once they get in the program, they get used to the program. This is typically something they use every year. And then when folks start to retire, what they start to do is ratchet down, just kind of covering their year 6. Like when you sell the equipment in year 6, it's a sale, so it's a gain. It's an income gain. And so in year 6, it's kind of like, what's the solution there? Well, you can buy more equipment. There's more complicated things like non-grantor trust you can use to get a step up in basis if like your parent passes away or whatnot with estate planning. There's like complex stuff like that. But the biggest thing I always focus on is this year. I'm using the best tax planning for this year, bringing up my capital to reinvest it in all my projects. And then each year it's like, okay, what's the best program this year, right? And I utilize that program. So it's like every year I re-look at this and just pick the best program of that year. So there's some solutions out there for year 6 when you sell that equipment and have an income gain, but also know that 6 years from now, things may change and there may be better solutions out there. About 4 to 6 weeks on the whole process with the lending. That's the biggest bottleneck. Is there enough equipment, right? Gets really competitive for equipment towards the end of the year, like super competitive. And so I always recommend people get starting on the lending process now. Like I said, pick the bigger amount. That way you're through the long curve of the lending process, trying to get lenders to underwrite people during like Thanksgiving, Christmas. It's not fun. And then it's really easy for you to pull the trigger at the end. When you're ready, if you've gone through that lending process. So first step is typically just schedule a 20-minute call with Claudio and I. Claudio is my lead on OwnaFleet. He's very sharp. You like Claudio a lot. We'll just answer any questions you have, make sure you understand it. Then we start the credit application. Probably take you half an hour. Just got to upload tax returns, those kind of things. Sometimes the banks come back and say, hey, can you send me your K1s? Those types of things, any other loan. Then we'll present the deal structure to you. Yeah. So
can we use our own bank, or do we need to, like, what's the,
you can use your own bank.
you go to like a special bank that does this often? I mean,
yeah, we do. So we have one of the people on our platform is a debt broker who works in equipment specifically, and they've been doing this for many years. And so they go around the country to different credit unions, banks, talk about the program, get these folks to sign up, right? Okay, we're going to fund 300 million. We're going to fund 100 million, right? And then we'll fund it at like this income level. So we take these different banks, credit unions, match it to like your region, and say, hey, this is the interest rate we're getting, right? The harder part here is the leverage, right? Because this is 90-10. So we're getting banks on board with this 90-10 leverage. We're getting banks on board with the platform, and then interest rates usually come in between 6.75 and 7.25, depending on somebody's personal financial status. Now, the easier solution that I see some people do, who like some of the family offices, they'll say like, okay, we have like $10 million in like equities, right? In index funds, like sitting in like Merrill Lynch, right? Or IBKR is one that probably has the best rates, which is like Merrill Lynch for professionals. So if it's like an IBKR, $10 million worth of index funds, they can go borrow like 70% of that, and it's like the lowest interest rate, maybe like 5.5% or something. So sometimes I see that, but it's just hard to get banks on board with the 90-10 leverage. And the more leverage on these, the better your tax efficiency is. So that's a super important part of the program.
okay.
the risk
So most
is,
people don't use their own bank. Most people just go through the broker that I guess he works for you or with you.
yeah, yep, yep. They're the ones that have like the application. We'll do a little application on my page that gets you in their system, and they'll send you information and they have like a whole portal that they go through with you. Yeah, so it's not like we're saying, hey, you need to use them. Like, if you've got a good relationship, or you know your bank will just do it, like, and at a lower rate, like, do that. That's not a problem. What happens a lot is, we explain it to the bank. They have to understand it. Once they finally understand it, they put it through. They put the application to. They finally present to their loan committee, and then their loan committee says no, right? And that was like a 2-month process. And they're like, oh no. Like one of the guys I know, he's very complex. He's very entrepreneurial. He shows no income. And he just went through with like a credit union. Same thing. And it was like, they're like, yeah, we can do this. We can do this. And it was like 2 months in, and like, they're like, oh, I'm sorry, we can't do this. And so, yeah, that's just a thing to watch out for. So,
Okay.
good question. So yeah, I mean, you can always run it by your folks, but the biggest thing we see is loan policy. Most folks have like a loan policy on like equipment for businesses, and then they have like debt service coverage ratio covenants. And so you got to work through those two pieces with the bank to get exceptions. One of our lenders like really understands it, and they just cranked last year. It does a ton of volume through them. And yeah, they understand it. They like the program. They actually resell a lot of the loans, so they're not keeping all of them on their own books. Once you get a bank or a credit union kind of like churning like that, then it just goes pretty smooth because they've done so much. Matt, Mick, Chance, Jitesh, Michael, Heck, Ray, any more questions? Okay. We're all about long-term relationships here. This is one of our programs. As I mentioned, we also have Cochran Capital. So we have a private real estate fund, which is good for just diversifying investment income. These are projects I build locally. By far the largest investor in each project. So I have all the skin in the game. And we also do a lot of opportunity zone work. Opportunity zone work is the best solution I found for folks who like real estate investing and have capital gains. It's what I use. It's a great program, and it got made permanent with the big, beautiful bill. So if you guys have questions about OwnaFleet or real estate or opportunity zones, yeah, we're always here. Book a call anytime. Any other final? Okay. Well, thanks for tuning in, everybody. Thanks for hanging out on a Friday morning or early Friday afternoon if you're on the East Coast. And look forward to chatting next time. Take care.
Thanks, Josh.
Josh, look forward to getting your email. Thanks.
Yes, we were good at follow-ups, so we'll get you guys those.
Okay.
Our pleasure. Take care.
Take care, guys.
Bye.